Hello, fellow TPH people. This is Yoda here, and I'm just going to show you a little bit about how I trade the markets. And this is just kind of unique to me. I don't know if anybody else in the world trades this way, but it's worked out for me, and it's, as you'll see, it's a very good way to make money very quickly. And I'll just show you how these charts and some of the indicators I use on these charts work. Basically, there are hundreds, maybe thousands of different indicators you can use, and these particular ones over the years are just the ones I felt worked best for my style of trading. And I'll just show you a screen capture of this morning's NASDAQ chart. I'm trading the NASDAQ E-mini, which is like a smaller portion of the total NASDAQ contract. But don't let the name fool you. You can make a lot of money on this. And for example, each grid line on this chart you see here is equal to a point, which is worth $20 per contract. Now you could trade up to 100 contracts at a time, so you can see where that would quickly be a good way to gain money. For example, the average each of these bars, these black bars, are 1 minute of time, and you can see that a lot of these bars, they're moving 1, 2, 3, 4, 5, 6, 7 points at a time. And so that's 7 times 20, $140 in a minute per contract. So that's quicker than most avenues to make money that I know of. And you can see that by the scale here on the right that I've set each grid line to equal a point. You can set the scale the way you'd want it. You can have it auto scale. I just like to set it a point apart. Helps me quickly keep track of where my target is. If I'm shooting for 5 points or 2 points, and so I can see that at a glance. It's also good for indicating volatility. When these lines become really close together to the point where they're becoming gray, that means the market's getting really volatile. And right now, I'd say the volatility is probably on the moderate side compared to what it has been over February and those months. Right now, I would say it's probably at the perfect volatility that I like for trading. This is the May 1st chart. And let's see if we go to the bottom here. Here's where the U.S. market opens at 6:30 Pacific time out here in California. So that's when I started trading, right here at 6:30. And you can see for the first around 8 minutes into the trading, it's really not going anywhere. And these areas I kind of refer to as congestions. And I don't like to normally trade within these until I have a good solid idea of where it's going, because these can do what is known as whipsawing you. You can take a position and it immediately reverses on you, and you reverse your position and only to chase the market. And that's a good way to really lose money quickly. So I try to avoid that situation. What I try to do instead is trade the breakouts of those. For example, I'll show the this would be the resistance area, and basically this is the support, and that's kind of the rough estimate of where those lines would be. I like to try to trade at the breakouts of those. For example, I might go short here as it's breaking out. I'll use a red line for going short or selling. in trading commodities or futures, the futures market, it's very easy to trade in both directions because you're using a leveraged contract, and that's margined. You can do that also with stocks. You just have to talk to your broker about how to get into leveraged or margin stocks. Open up a margin account. But generally, all the futures markets are all leveraged, so you can trade going in every direction, and which is really the only way I would prefer to trade, because there's so much potential in every direction. So that's one way to trade, is just trading breakouts. These indicators that I've shown here, the blue line is the 8 exponential moving average, 8 period exponential moving average. And I use that indicator relative to the 14 period simple moving average, which is magenta colored. I just arbitrarily chose these colors, but just to distinguish the two indicators. The 14 simple moving average is the center line, basically, of the Bollinger Band indicators. The Bollinger Bands are these gray outer envelopes, and they're based off a central indicator, the simple moving average line. And these indicate volatility by how far they are away from the central line. It's through some formula that I knew once, but I would have to look it up. But the important thing is that you know that the Bollinger Bands indicate volatility. When they expand outward, the market's getting more volatile. When they contract together, it's getting less volatile. And usually that's a sign that at a certain volatility, when it starts really contracting inward like that, I tend to be a little bit more cautious. But in this case, the market's volatile enough where I wasn't really worried about it. So to give you a quick and not a sick way of trading, a quick and dirty way of trading that doesn't take too much education at all. Just look at these areas where the 8 exponential moving average, the blue line, is crossing over the 14 simple moving average. And these crossover points are really excellent trade entry points. Looking back, it looks extremely easy to spot these, but in real time it's a little bit more difficult, and they can fake you out because lines are moving all the time. But it's very doable. You can spot these, and I'll just show you some basic entry points that anybody can learn, even let's say a first grader. Just looking at the pictures of the chart, you don't really need to know anything about trading exactly. Just a few simple rules and these indicators, and you could spot them. For example, as the you want to trade the side of the market that the blue 8 exponential moving average is on relative to the 14 period simple moving average. So this is below the 14 period simple moving average, so we'd want to trade to the downside, so we trade short at the crossover. So I'll just mark a red line for going short, and a good quick and dirty way of getting out would just be to exit the market when it hit the Bollinger Band envelope. And so if you did nothing more than that, you can see that trade right there. If you went short just as it crossed over, you would gain, let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So let's say 11 points, which is, $220. $220 just for, in a minute's time. Each one of these bars is a minute per contract traded, and all you did was just look at the crossover here and hit a button that says go short. And let's see if I can Well, I don't have that up, but I was going to show you what the button looks like. It's just a simple button. It says sell. It's a red button, and the green button is to go long at the market. So there are three basic types of orders in the market. There's a market order, there's the stop order, and then there's a limit order that I use. And if you really want to just take it to its basic level, just hit the sell at the market button. And it's that easy. Suddenly you're short right here. And then there's another button. You just hit exit at the market and cancel. And as you hit the lower Bollinger Band, and you've made $220 for your troll. You can see it does the same thing here. As it's crossing over to this side, you just hit the buy at the market button. Get out it when it hits the upper Bollinger Band. In this case, since we're in a longer uptrend, you'd have to, if you wanted to take full advantage of that, you could enter the market again as it came back down towards the 8-period exponential moving average, the blue line. And that's the tricky part, is finding this point right here, this what I call number 3 point. If you wanted to label them, this would be your number 2 point, or 2 point up here, the number 3 point there, and let's say the 1 point there. If you're following my pattern on how the basic market structure works, it's form, in 1, 2, and 3 points that you're looking for basically all the time. And so finding that number 3 point is a little bit difficult, but as it starts to move back up or bounce off the 8 exponential moving average, that's a good indication that it's going to continue in the uptrend, especially if the 8 exponential moving average is expanding out from 14 simple moving average like that. People have called that, or compared it to a alligator's mouth opening. You want that expansion. That says you're in an uptrend. So when it hits that, or it comes close to that 8 EMA line, you go long, and you're once again back in the market. It hit the upper Bollinger Band right there. Get out there, and then you can get in the market for the same reasons again over here. Get out up here, and the difficulty with this, you can enter the market again here, but sometimes it doesn't always hit the Bollinger Band, so you got to be really quick when you see it reversing on you like that. Just get out, and you've made another $3.60 profit right there. So now we come to our third crossover point. You sell and go short right there, and same criteria. You get out at the when it hits the Bollinger Band on the bottom, and you can do this all day just by looking at these chart formations with the right indicator set up. And it's as simple as that, or it can be. There are some variations to this. It doesn't always work this well, but that's there's subtleties with everything, and you kind of learn or train yourself to know when it's faking you out, or it's when it's not really going to cross. But what I like to do is make sure it's actually crossed before I make the trade. You don't have to tempt it right before the crossover. And so just have a lot of patience and wait for the cross to occur, and then wait for the bar to take out the high of the previous bar after the cross. And you make money every time. Simple as that. And same criteria. We'll get in again at the uptrend. Get out again here at the Bollinger Band. And you can see even as the chart goes off the screen, you had another opportunity right there to go short. So that's basic, quick and dirty, a quick and dirty method of trading that anyone can learn. I could probably teach a first grader how to do this just by observing a few times. and it's really not that hard to figure out. You don't need to be a rocket scientist or anything, or do any math. I've already done all that just by having discovered these relationships between different periods of, different indicators of different periods, how their relationship is together. Basically, they're like sine waves of different periods. You've got one sine wave that's moving at an 8-period moving average, and you've got the other one moving at a 14-period, and those relationships work out well for this trading method for one picking out crossover points. If you did this all day long, I don't know how much money is here, but this has got to be over just a section of charting here from 6:30 to 7:30. That's about I'd have to add it up, but I'd say it's going to be over $800 per contract just for doing that simple thing. You didn't have to go to any college to learn this or any school. I could teach it to anybody in 5 minutes, and you've got a really high probability trading method right here. And very few times you're going to lose with this method. All right, this is Cy's first time talking on video, so like I said, I'm not really a good speaker, but anyway, I hope I got the idea across. Maybe it's a little bit better than I explain it. And writing can be boring, and maybe chart reading in general is boring, but to me, I think making money is interesting. Everybody has an interest in that. So I'll see you at the message board. Now I got to figure out how to edit this thing.